If I offered to sell you a genuine $100 bill for $50, would you take the deal? The answer, unequivocally, is yes. You would take that deal as many times as I offered it. You would not need to consult a chart, you would not care what your neighbor thinks about the transaction, and you certainly would not care if the price of that bill fluctuates in the next hour. You understand the inherent worth of the asset, which is $100, and you recognize the opportunity to acquire it at a significant discount. This simple logic is the absolute bedrock of successful investing. It is the philosophy that built the fortunes of Benjamin Graham and Warren Buffett. Yet, when we move from simple currency to the stock market, the vast majority of investors lose this clarity. They stop looking at the value of the bill and start obsessing over the flashing price tag. They buy stocks not because they are worth more than the asking price, but because they hope someone else will pay even more for them next week. That is not investing. That is speculation. Welcome to the Money Answer DCF Masterclass. Over this comprehensive series, we are going to strip away the noise of market sentiment, media hype, and technical patterns. We are going to focus on the single, most important number in finance: intrinsic value. Intrinsic value is the true, calculated worth of a company, completely independent of its current stock price. The market price is what you pay. Intrinsic value is what you get. The gap between these two numbers is your margin of safety. If you do not know the intrinsic value of a company, you are flying blind. You are purchasing an asset without knowing its worth. You are essentially walking into a supermarket without price tags, filling your cart and hoping the total at the register is reasonable. No rational person manages their household finances this way, yet millions manage their life savings this way. In this masterclass, we will master the discounted cash flow analysis, or DCF. This is not a get-rich-quick scheme or a trading strategy for short-term gains. This is the valuation methodology used by investment banks, private equity firms, and the world's most disciplined value investors. It is a tool for the serious, long-term investor who views a stock not as a ticker symbol, but as a fractional ownership in a real, operating business. By the end of this series, you will possess the analytical framework to look at any company, whether it's a tech giant or a manufacturing firm, and determine exactly what it is worth per share. You will learn to ignore the crowd and trust the math. We are going to calculate the present value of future wealth. Let us begin. To perform a discounted cash flow analysis correctly, you must first adopt the correct mental framework. You must strip the company of its brand name, its CEO's charisma, and its stock chart. You must view the company purely as a financial engine. What is a company fundamentally? It is a machine designed to deploy capital today in order to generate more capital in the future. That is it. When you buy a share of a company, you are buying a claim on the cash that the company will generate for the rest of its life. Therefore, the value of that company today is simply the sum of all the cash it will ever produce, adjusted for time. This brings us to the core definition of the DCF, a valuation method used to estimate the value of an investment based on its expected future cash flows. The analysis attempts to figure out the value of a company today based on projections of how much money it will generate in the future. However, there is a critical catch, and this is where the discounted part of the name comes into play. A dollar to be received 10 years from now is worth significantly less than a dollar today. This is the principle of the time value of money. Why is this the case? There are two primary reasons. First, inflation erodes purchasing power. A dollar in 2035 will simply not buy as many goods as a dollar today. Second, and more importantly, is the concept of opportunity cost. If you have a dollar today, you can invest it in a risk-free asset, like a government bond, and earn interest. In 10 years, that dollar will have grown. Therefore, if you are forced to wait 10 years to receive your money, you must be compensated for that waiting period. Imagine you are looking at a private business, like a local car wash. The owner tells you the car wash will generate $10,000 in profit every year for the next 10 years. You would not pay $100,000 for that business today. Why? Because you have to wait a decade to get your money back. You're taking on risk. The machine might break. A competitor might open across the street. You need a discount to justify the risk and the wait. The DCF formula mathematically applies this logic. It takes those future streams of cash, forecasted 5, 10, or 20 years out, and it shrinks them back to their present-day value. Using a specific rate known as the discount rate, this rate acts as a hurdle. It represents the return you require to justify the risk of the investment. If the future cash flows, once discounted back to the present, sum up to a number higher than the current stock price, the stock is undervalued. It is the dollar bill selling for 50 cents. If the sum is lower than the current price, the stock is overvalued. The math provides an anchor of reality in a sea of market emotion. It forces you to justify every assumption. It demands that you think about the business's longevity, its growth prospects, and the inherent risks. This is not just a formula, it is a discipline. It forces you to think like a business owner, not a stock trader. In the world of finance, you will often hear about the PE ratio, the price to earnings ratio. Analysts might say this stock is trading at 15 times earnings. Its competitor is at 20, so it is cheap. This is known as relative valuation. While youthful, relying solely on relative valuation is a dangerous trap. Relative valuation is like comparing the prices of houses in a neighborhood where every single house is overpriced. If a shack costs $1 million and a mansion costs $2 million, the shack might seem cheap by comparison. But if the real value of the shack is only $100,000, you're still making a terrible investment. During market bubbles, entire sectors become overvalued. In such an environment, a stock with a lower PE ratio is simply the cleanest shirt in the dirty laundry pile. It is still a bad investment. The discounted cash flow analysis differs because it is an absolute valuation method. It does not care what the rest of the market is doing. It does not care if the sector is hot or cold. It looks strictly at the cash-generating capability of the specific asset in question. If the market crashes tomorrow, the PE ratio might change wildly, but the intrinsic value derived from a DCF remains stable, provided the business fundamentals have not changed. Furthermore, PE ratios rely on earnings or net income. As any seasoned accountant will tell you, net income is an accounting fiction. It contains non-cash items, depreciation schedules, and various accruals that management can manipulate to smooth out results or hit quarterly targets. A company can show a profit on paper while effectively bleeding to death financially. Cash flow, however, is much harder to fake. Cash is fact. Either the money entered the bank account or it did not. The DCF model focuses on, we are looking for something far more tangible, free cash flow, the actual cash available to be distributed to shareholders after the company has paid its bills and reinvested in the business. By focusing on cash rather than accounting earnings, the DCF cuts through the accounting fog and reveals the economic reality of the business. We have now established the philosophy. You understand that a stock is an ownership stake in a stream of future cash, and you understand that our goal is to discount that cash back to today's dollars to find the intrinsic value. But here lies the challenge. The formula is perfect, but it is only a calculator. It requires inputs. The most critical and, frankly, the most difficult input to determine is the free cash flow. How do we accurately predict how much cash a company will generate 5 years from now? If you get this number wrong, the entire valuation collapses. In part 2 of this masterclass, we are going to solve the first variable of the equation. We will deep dive into free cash flow forecasting. I will show you how to look at historical data, analyze revenue growth, and estimate margins to build a projection you can trust. Let us begin. Now, we must move from philosophy to mechanics. If the formula for value relies on future cash flows, then the accuracy of our valuation depends entirely on the quality of our inputs. You have likely heard the phrase garbage in, garbage out. This axiom is nowhere more relevant than in financial modeling. If you input optimistic, unfounded, or erroneous cash flow projections into a DCF model, the model will return a valuation that is mathematically correct but financially disastrous. Therefore, the most critical skill you must develop is not the ability to solve complex equations. It is the ability to accurately forecast the cash-generating power of a business. We are not looking for earnings or net income. We are looking for something far more tangible and far harder to manipulate: free cash flow. In this section, we will define exactly what free cash flow is and why it differs significantly from the profit figures you see in headlines. I will guide you through the rigorous process of forecasting the three main drivers of value. 1. Revenue growth. 2. Working capital changes. And 3. Capital expenditures. By the end of this session, you will understand how to construct the numerator of our valuation equation. Before we can forecast, we must define our terms with absolute precision. When we speak of cash flow in a DCF context, we are specifically referring to free cash flow to the firm, or FCFF. The definition is straightforward. Free cash flow is the cash that a company generates from its operations, after deducting the money required to maintain and expand its asset base. It is the cash that is free to be distributed to the providers of capital, both the debt holders and the shareholders. And it does this without jeopardizing the ongoing operations of the business. The formula is as follows. You start with operating cash flow and you subtract capital expenditures. You might ask, why go through this trouble? Why not simply use the net income figure found at the bottom of the income statement? This is a common error made by novice analysts. Net income is an accounting construct, not a measure of liquidity. It is governed by accrual accounting principles, which attempt to match revenues and expenses to the time period in which they occurred, rather than when the cash actually moved. Consider two major distortions that make net income unreliable for valuation. First, net income includes non-cash expenses, the largest of which is depreciation and amortization. If a company builds a factory for $100 million, it spends that cash up front. However, on the income statement, accountants might spread that cost over 20 years, deducting only $5 million a year from revenue. This makes the company look more profitable than it actually is in the year of construction and less profitable in subsequent years, even though no cash is leaving the door. Net income obscures the timing of cash movements. Second, and conversely, net income ignores the cash required for reinvestment. A company might report a massive profit of $50 million. However, if that company had to spend $60 million on new machinery just to keep its assembly line running, the business actually burned $10 million of cash. It has a negative free cash flow. A shareholder looking only at net income sees a thriving business. A shareholder looking at free cash flow sees a company bleeding liquidity. We care about distributable cash. You cannot pay dividends with net income. You cannot pay down debt with net income. You can only do those things with free cash flow. Therefore, to value a business, we must start with earnings before interest and taxes, or EBIT. Apply the tax rate to get net operating profit after taxes. Add back non-cash charges like depreciation, and then subtract the actual cash outflows needed for capital expenditures and working capital. This process converts an accounting opinion into a financial fact. Now that we have defined free cash flow, we must project it into the future. A standard DCF analysis usually requires a 5 to 10-year forecast period. To do this, we do not simply guess a final number. We must build the forecast from the bottom up, driver by driver. The first and most influential driver is revenue growth. Forecasting revenue requires a blend of quantitative history and qualitative judgment. You must look at the historical compound annual growth rate, or CAGR, over the last 5 to 10 years. Is growth accelerating or decelerating? However, you cannot simply extrapolate a straight line into infinity. As companies grow, they inevitably encounter the law of large numbers. It is harder to grow a $10 billion company by 20% than it is to grow a $10 million company by the same rate. You must adjust your revenue assumptions based on the total addressable market and industry trends. If you are valuing a mature utility company, a growth rate slightly above inflation, perhaps 2 or 3%, is appropriate. If you are valuing a high-growth technology firm, you might project 20% growth for the first 3 years, tapering down to 10% by year 5. Your assumptions must be defensible. The second driver is operating margin. Revenue is vanity. Profit is sanity. We need to apply an operating margin to our revenue to find the EBIT. You should analyze the company's historical margins. Are they stable? If a company has consistently earned a 15% operating margin, it is generally safe to project that forward. However, if the company is scaling, you might factor in operating leverage. This is the concept that as revenue grows, fixed costs stay the same, leading to expanding margins. Be conservative here. It is better to underestimate efficiency than to overestimate it. The third and most technically complex driver is the change in net working capital. Net working capital is defined as current assets minus current liabilities. It represents the capital tied up in the day-to-day operations of the business. Inventory on the shelves, invoices waiting to be paid by customers, and bills the company owes to suppliers. Here is the counterintuitive rule you must memorize. An increase in net working capital is a cash outflow. It reduces free cash flow. This often confuses students, so let us visualize a simple grocery store. If the owner wants to double their sales, they must first fill the shelves with twice as much food. To do that, they must take cash out of the register and pay suppliers for that inventory. Now, look at the store. The shelves are full of assets, but the cash register is empty. The money is trapped on the shelves. Until that food is sold, that cash is gone. This illustrates perfectly why an increase in assets is a decrease in cash. Similarly, if a company sells more products on credit, its accounts receivable balance grows. This is revenue recorded on paper, but the cash has not yet been collected. It's an IOU, not liquidity. To forecast this, we use efficiency ratios. Days sales outstanding for receivables, days inventory outstanding for inventory, and days payables outstanding for payables. You generally forecast these ratios to remain constant or improve slightly. You then calculate the dollar change in working capital year over year. If the business is growing, this number will usually be negative, representing a drag on cash flow. The final driver is capital expenditures, or CapEx. This represents the cash spent on physical assets, property, plant, and equipment. We usually forecast CapEx as a percentage of revenue. You must distinguish between maintenance CapEx, which is the money needed to keep current assets running, and growth CapEx, which is money spent on expansion. For a mature company, CapEx might essentially match depreciation. For a high-growth company, CapEx will be significantly higher than depreciation as they aggressively build infrastructure. You must look at the company's strategic guidance. If they plan to open 50 new stores next year, your CapEx forecast must reflect the cost of building those stores. If you underestimate CapEx, you will artificially inflate the free cash flow and end up with an overvalued stock. By combining these elements, revenue minus expenses adjusted for taxes plus depreciation minus working capital increases minus CapEx, you arrive at the projected free cash flow for each year of your forecast period. We have now completed the first half of the equation. We have a stream of estimated free cash flows for the next 5 to 10 years. These numbers represent the potential wealth the company will generate. However, a promise of cash in the future is not the same as cash in your hand today. To find the intrinsic value, we must bring these future cash flows back to the present. We must discount them. But at what rate? What number represents the risk of the investment and the time value of money? This brings us to the discount rate, specifically the weighted average cost of capital, or WACC. This is often considered the most intimidating part of the DCF, but it is merely a calculation of the return that investors demand. However, if you were to simply add up those future cash flows and call that the value of the company, you would be making a catastrophic financial error. $1 million generated 10 years from now is worth significantly less than $1 million in your pocket today. We established this in part 1. Money has a time value, and every investment carries a specific level of risk. To convert those future uncertain cash flows into a precise present-day value, we need a mechanism to discount them. We need a specific percentage rate that reflects the risk profile of the company. In the world of professional finance, this rate is not chosen arbitrarily. It is calculated with mathematical precision, using a metric known as the weighted average cost of capital, or WACC. WACC is the bridge between the future and the present. It represents the minimum return that a company must earn on its existing asset base to satisfy its creditors, owners, and other providers of capital. If the company cannot generate returns that exceed this cost of capital, it is destroying value, regardless of how much profit it shows on the income statement. Understanding WACC is the difference between an amateur guess and a professional valuation. The weighted average cost of capital is exactly what its name suggests. It is the average rate a company expects to pay to finance its assets, weighted by the proportion of debt and equity in its capital structure. Think of a company as a massive project funded by two distinct groups of people. First, you have the lenders, banks and bondholders, who provide debt. Second, you have the shareholders, institutional and retail investors who provide equity. Both groups demand a return on their money. The lenders demand interest payments. The shareholders demand stock price appreciation and dividends. The WACC is simply the blended average of these two demands. To calculate it accurately, we must first determine the weights of the capital structure. This is a common stumbling block. You must use the market value of equity and debt, not the book value found on the balance sheet. The market value of equity is simple. It is the company's market capitalization, the current stock price multiplied by the number of shares outstanding. This reflects what the market currently believes the equity is worth. The market value of debt is often harder to pinpoint, but for most stable companies, using the book value of debt is an acceptable proxy, provided interest rates have not shifted dramatically since the debt was issued. Once you have these two numbers, you sum them to get the total capital. You then calculate the percentage of the total that comes from equity and the percentage that comes from debt. For example, a stable consumer goods company might be financed 60% by equity and 40% by debt. These percentages are your weights. They determine how much influence the cost of equity and the cost of debt will have on your final discount rate. The formula is structured to reflect this balance: the weight of equity multiplied by the cost of equity plus the weight of debt multiplied by the cost of debt. This gives you a single percentage, perhaps 8 or 9%, that serves as the hurdle rate for the entire valuation. Now we arrive at the most theoretically complex component of the WACC, the cost of equity. Unlike debt, where the cost is clearly visible as an interest rate, the cost of equity is implicit. It represents the rate of return that shareholders require to hold the stock. Since there's no contract stating exactly what return a shareholder will get, we must estimate it. To do this, we use a Nobel Prize-winning economic theory called the Capital Asset Pricing Model, or CAPM. The CAPM logic is elegant. It states that the required return on a stock is equal to the risk-free rate plus a risk premium based on the stock's volatility. Let us break down the three critical inputs of the CAPM formula, and importantly, where you can find this data immediately. First, the risk-free rate. This is the baseline return you could get if you took absolutely zero risk. In professional valuation, we almost exclusively use the yield on the 10-year U.S. Treasury note. Why the 10-year? Because equity investing is a long-term endeavor. We want a risk-free benchmark that matches the duration of our investment horizon. You do not need to guess this number. It is publicly available data. You can find the current 10-year U.S. Treasury yield on Bloomberg, CNBC, or directly on the U.S. Department of the Treasury website. If the 10-year Treasury is yielding 4%, that's your starting floor. No rational investor would buy a risky stock for a 3% return when they could get 4% from the government guaranteed. Second, we have beta. Beta is a measure of a stock's volatility in relation to the overall market. The market has a beta of 1.0. If a stock has a beta of 1.5, it is 50% more volatile than the market. If the market goes up 10%, this stock theoretically goes up 15%. But if the market drops 10%, this stock crashes 15%. This implies higher risk. Many students fear they have to calculate this manually using regression analysis. You do not. Every major financial data portal, from Yahoo Finance to Morningstar to Reuters, publishes the beta for public companies on their summary page. As a beginner, it is perfectly acceptable to use this published number. It measures systematic risk that cannot be diversified away. High beta stocks like technology or biotech require a higher expected return to compensate investors for the roller coaster ride. Third, we have the equity market risk premium. This is the additional return that investors demand for holding stocks over risk-free government bonds. Historically, the stock market has returned about 5 to 6% more than bonds over the long run. Most analysts use a standard range between 5% and 6% for developed markets. The CAPM formula brings this all together. Cost of equity equals the risk-free rate plus beta multiplied by the market risk premium. Let us walk through a practical example using data you sourced. Assume you looked up the 10-year Treasury yield and found it to be 4%. You checked Yahoo Finance and found your target company has a beta of 1.2. You assume a standard market risk premium of 5%. You multiply the beta of 1.2 by the risk premium of 5%, which gives you 6%. You then add the risk-free rate of 4%. The result? 10%. This 10% is your cost of equity. It means that given the risk profile of this specific company, shareholders theoretically demand a 10% annual return to justify holding the stock. This number is often the largest driver of your WACC because equity is usually the most expensive form of capital. The cost of debt is significantly more straightforward to calculate than the cost of equity. Yet, it contains one vital nuance that you must not overlook: the tax shield. The pre-tax cost of debt is simply the effective interest rate the company pays on its loans and bonds. You can estimate this by looking at the company's income statement. take the interest expense line item and divide it by the total debt found on the balance sheet. This gives you the average interest rate they are paying. However, because governments generally allow companies to deduct interest payments from their taxable income, debt is effectively subsidized. If the corporate tax rate is 25%, every dollar of interest paid only costs the company 75 cents in real terms. Therefore, the formula is the pre-tax cost of debt times 1 minus the tax rate. This after-tax cost of debt is almost always lower than the cost of equity, which is why companies often use debt to lower their overall WACC. We have now calculated the WACC. We have our discount rate. We have successfully determined the hurdle rate that we will apply to our forecasted cash flows from Part 2. But we have a problem. Our forecast in Part 2 only went out 5 or 10 years. Companies, ideally, live forever. A massive percentage of a company's value comes from the cash it will generate in the years after our forecast period ends, from year 11 into infinity. How do we value infinity? We have reached a critical juncture in our valuation journey. Up to this point, we have meticulously constructed a forecast for the immediate future. In Part 2, we projected the free cash flow for a specific period, typically 5 to 10 years. In Part 3, we calculated the WACC, the precise discount rate required to bring those future cash flows back to present value. However, we face a significant logical hurdle. When you purchase a share of a high-quality company, whether it is a consumer staple giant or a technology leader, you are not buying a stream of cash flows that simply evaporates after year 10. You are buying a going concern. The fundamental assumption of equity investing is that the corporation has an indefinite life. It will theoretically continue to operate, generate cash, and pay dividends forever. If our model only accounts for the next decade, we are ignoring the vast majority of the company's lifespan. We are accounting for the tip of the iceberg while ignoring the massive mass submerged beneath the surface. In professional valuation, the value attributed to the years beyond our explicit forecast period is known as the terminal value. It is not uncommon for the terminal value to account for 60, 70, or even 80% of the total calculated value of a stock. This is a sobering realization. It means that the bulk of your investment thesis rests not on what the company will do in the next few quarters, but on a mathematical assumption about what it will do in perpetuity. Because this number is so large and influential, it carries the highest risk of error. A slight miscalculation here can artificially double a stock's value or cut it in half. In this session, we will approach the terminal value with extreme caution and mathematical rigor. We will use the perpetuity growth model to value the company's indefinite future. And then we will synthesize every component we have built so far to arrive at the total enterprise value. To estimate the value of a company from year 11 into infinity, analysts typically use one of two methods: the exit multiple method or the perpetuity growth method, also known as the Gordon growth model. While the exit multiple method is popular in private equity for its simplicity, for this masterclass we will focus on the perpetuity growth method. This approach is academically pure and forces you to confront the economic reality of long-term growth. The perpetuity growth model asks a specific question: what is the value of a stream of cash flows that grows at a constant rate forever? The formula is deceptively simple, yet it is derived from complex geometric series mathematics. The formula for terminal value is the free cash flow of the final forecasted year times 1 plus the perpetual growth rate, divided by the WACC minus the perpetual growth rate. Let us break down the numerator first. We take the free cash flow from the very last year of our explicit forecast, let's say year 10, and we grow it by 1 year. This gives us the estimated cash flow for year 11, which is the first year of our perpetuity period. We are essentially establishing the baseline cash flow for the rest of eternity. Now, look at the denominator. WACC minus the perpetual growth rate. This is often called the capitalization rate. Conceptually, you are taking the expected return required by investors and subtracting the growth you expect the company to achieve. Think of it this way. The WACC pushes the value down because risk reduces value, while the growth rate pushes it up. The difference between these two forces determines the multiple you are paying for that cash flow. As the spread between WACC and the growth rate narrows, the terminal value skyrockets. For example, if your WACC is 8% and your growth rate is 2%, you are dividing by 6%. But if you aggressively assume a growth rate of 6%, you are dividing by only 2%. Dividing by a smaller number yields a massively larger result. This mathematical sensitivity highlights why the inputs for this formula must be chosen with conservative precision. If you get the denominator wrong, you break the valuation. This model assumes a steady state. It assumes the company has matured. It is no longer reinvesting aggressively for hypergrowth. It has stable margins, stable capital expenditures, and its growth is driven by macroeconomic factors rather than company-specific disruption. This brings us to the most dangerous variable in the entire DCF model, the perpetual growth rate, or G. Selecting the perpetual growth rate is where amateur analysts destroy their credibility. The temptation is always to pick a high number. If the company has been growing revenue at 15% for the last decade, why not use 5 or 6% as the perpetual growth rate? You must absolutely resist this urge. You must understand the law of large numbers and basic macroeconomics. The perpetual growth rate represents the rate at which this company will grow forever. If you assign a company a perpetual growth rate of 5% while the global economy grows at only 3%, you are mathematically implying that this company will eventually become larger than the entire global economy. Over a long enough timeline, a company growing faster than the economy will consume the economy. This is a mathematical impossibility. Therefore, the golden rule of the terminal value is this: your perpetual growth rate must never exceed the long-term growth rate of the economy in which the company operates. For a mature company in a developed market like the United States or Western Europe, the ceiling for growth is usually the long-term risk-free rate, or the expected GDP growth rate. In nominal terms, this usually falls between 2% and 3%. This rate is essentially a proxy for inflation plus a tiny sliver of population growth. When you say a company will grow at 2% in perpetuity, you are really saying this company will simply maintain its market share and raise prices to keep up with inflation forever. That is a defensible, conservative assumption. If you are valuing a company in a declining industry, you might even use a growth rate of 0% or a negative growth rate. There is no law that must say companies must grow. Kodak or Blockbuster in their final years would have warranted a negative perpetual growth rate. You must also perform a sensitivity analysis. When you build your model, do not just pick one number. Test the valuation at 2.0%, 2.5%, and 3%. You will see that a 0.5% difference in this input can change the final stock price by 10 or 20%. This sensitivity should scare you into conservatism. Always err on the side of caution. It is better to be pleasantly surprised by a company's longevity than to be wiped out by an over-optimistic assumption about its immortality. We have now generated all the raw materials. We have a series of free cash flows for years 1 through 10. We have a massive terminal value calculated at the end of year 10. And we have our WACC. Now, we synthesize. We must bring everything back to today, time zero. First, we take each individual free cash flow from the forecast period, years 1 through 10, and discount them back to the present using the WACC. For year 1, we divide the cash flow by 1 plus WACC to the power of 1. For year 10, we divide by 1 plus WACC to the power of 10. We sum these present values together. This sum represents the value of the company's growth phase. Next, we must handle the terminal value. Remember, the formula we used in the previous chapter calculated the value of the company as of year 10. To us, standing here today, that money is a decade away. This is the most critical step, and where many valuations fail. You cannot simply add the terminal value to your other cash flows. You must put that massive number into a mathematical time machine and bring it back to the present. You must take that terminal value and discount it back 10 full years using the WACC. We divide the terminal value by 1 plus WACC to the power of 10. If you skip this step, you are treating money you will receive in 2035 as if it were in your pocket in 2025. This error will inflate your valuation astronomically and lead to a disastrous investment decision. Always double-check this specific calculation. Finally, we add the sum of the present values of the free cash flows to the present value of the terminal value. The result is the enterprise value. It is crucial to understand what this number represents. Enterprise value is the value of the company's core business operations to all capital providers. It is the price you would theoretically pay to acquire the entire operating entity, taking over its factories, its brand, its inventory, and its cash flow generation free and clear of its financing structure. It is the value of the machine itself, regardless of who owns it. However, as an individual investor, you are not buying the entire company, and you are not paying off the company's debt. You are buying a share of common stock. You are an equity investor. The enterprise value we just calculated belongs to everyone: the bankers, the bondholders, and the shareholders. Before you can claim your piece of the pie, the lenders must be paid first. In the final installment, Part 5, we will perform the last crucial calculation. We will bridge the gap between enterprise value and equity value. We will subtract the net debt, add non-operating assets, and finally, divide by the number of shares outstanding to arrive at the single most important number: the intrinsic value per share. We will then conclude with a case study to lock in this knowledge. Part 5 is where we find the buy price. In Part 4, we synthesize these elements to arrive at the enterprise value. This figure represents the total value of the firm's core operations, the price tag for the entire functional machine. However, we have not yet arrived at the number that matters most to you as an individual investor: the price per share. You cannot buy the enterprise value on the stock market. You can only buy common equity. Therefore, we must perform one final critical set of adjustments. We must bridge the gap between the value of the entire firm and the value of the shareholder's specific claim. In this concluding session, we will convert enterprise value to equity value, determining the intrinsic value per share. Then we will apply our entire framework to a hypothetical case study to cement your understanding. And finally, we will discuss the concept of the margin of safety, the ultimate protection for the intelligent investor. To understand the transition from enterprise value to equity value, you must visualize the capital structure of a company as a pie. The enterprise value is the entire pie. It represents the total value created by the business assets. However, this pie does not belong solely to the shareholders. Before the shareholders can take a single bite, the debt holders must be fed. When you buy a house, the enterprise value is the total market price of the home, say $1 million. But if the house has an $800,000 mortgage attached to it, your equity value is only $200,000. The principle in corporate finance is identical. To calculate equity value, we take the enterprise value we derived in Part 4 and we subtract total debt. This includes all interest-bearing liabilities, short-term debt, long-term bonds, and capital leases. This debt is a senior claim. It must be paid off before equity has any value. However, there is a positive adjustment to be made as well. We must add cash and cash equivalents. Why? Because when you acquire a company, you acquire its bank accounts. If a company has $1 billion in debt, but also has $1 billion in cash sitting in the bank, the net debt is zero. The cash cancels out the debt. Therefore, the refined formula is enterprise value minus net debt. Additionally, we must consider non-operating assets. These are assets the company owns that do not contribute to the operating free cash flow we forecasted in Part 2. This might include a minority stake in another company, a portfolio of real estate unrelated to the business, or excess marketable securities. Since these assets have value but were not captured in our cash flow forecast, their market value must be added directly to the equity value. So, the complete formula is enterprise value minus total debt plus cash plus non-operating assets. The result is the total equity value. We are now one step away from our goal. To find the intrinsic value per share, we simply divide the total equity value by the number of shares outstanding. A word of caution here. You should use the fully diluted share count. This includes not just the shares currently trading, but also the shares that would be created if management exercised their stock options or if convertible bonds were turned into stock. Using the diluted count prevents you from overestimating the value per share. The result of this division is the fair value of the stock. This is the number you have been working toward for this entire masterclass. You now have a specific number. Let us assume your DCF calculation resulted in an intrinsic value per share of $50. You look at the market and the stock is trading at $48. Do you buy? The answer is likely no. This brings us to the most important principle in value investing, the margin of safety. We must have the humility to admit that valuation is an art, not a hard science. Our model is built on assumptions about the future, assumptions about revenue growth, profit margins, and interest rates. If we are wrong about any of these inputs, our valuation will be wrong. If the true value turns out to be $45 and you bought at $48, you have lost money. To protect yourself against errors in judgment and unforeseen economic calamities, you must demand a discount. This discount is your margin of safety. Benjamin Graham, the father of value investing, insisted on buying stocks for significantly less than they are worth. If your calculated value is $50, a disciplined investor might require a 20 or 30% margin of safety before pulling the trigger. This means you would only buy the stock if it trades below $35 or $40. This gap between price and value is your shield. If the company performs worse than you expected, the margin of safety absorbs the damage. If the company performs exactly as expected, the margin of safety provides outsized returns as the market price eventually corrects upward to meet the intrinsic value. Never treat your DCF output as a precise target. Treat it as a range. If the stock is trading at a massive discount to your calculated value, the investment is attractive. If it's trading at or near your calculated value, it's a hold. If it's trading significantly above your calculated value, it's a sell. Let us solidify this entire methodology with a practical walkthrough. We will value a hypothetical entity named Tech Innovator Incorporated, a stable software company. Step 1. Forecasting free cash flow. We analyze Tech Innovator's financials. They generated $100 million in free cash flow last year. Based on their contract backlog and industry trends, we forecast revenue to grow at 10% for the next 5 years. We project their operating margins will remain stable at 25%. After accounting for taxes, working capital changes, and capital expenditures, we calculate a stream of free cash flows growing from $110 million in year 1 to $160 million in year 5. Step 2. Calculating WACC. We determine the discount rate. The risk-free rate is 4%. The company is moderately volatile with a beta of 1.2, and the market risk premium is 5%. Using the CAPM, the cost of equity is 10%. They have some debt with an after-tax cost of 4%. Weighted by their market value, we arrive at a WACC of 9%. Step 3. Terminal value. We assume that after year 5, Tech Innovator will mature and grow at the rate of the economy, 3% forever. Using the perpetuity growth model, we calculate a terminal value of roughly $2.7 billion at the end of year 5. Step 4. Synthesis to enterprise value. We discount the 5 years of individual cash flows and the massive terminal value back to the present day using our 9% WACC. The sum of these present values gives us an enterprise value of $2.1 billion. Step 5. Bridge to equity value. Tech Innovator has $500 million in debt and $100 million in cash. Their net debt is $400 million. We subtract the net debt of $400 million from the enterprise value of $2.1 billion. This leaves us with an equity value of $1.7 billion. Step 6. Intrinsic value per share. The company has 100 million shares outstanding. We divide 1.7 billion by 100 million. The result is $17 per share. Decision. We look at the stock market. Tech Innovator is currently trading at $25 per share. Conclusion. The stock is overvalued by nearly 50% relative to its intrinsic cash generation potential. Despite the hype, the math does not support the price. We do not buy. We wait for the price to fall below $12 or $13 to establish a margin of safety. You have now completed the Money Answer DCF Masterclass. You have traversed the entire landscape of fundamental valuation. You possess the knowledge to look past the ticker tape, ignore the screaming heads on television, and deconstruct the financial reality of any public company. The discounted cash flow model is more than just a spreadsheet. It is a discipline. It forces you to ask the hard questions. Is this company actually generating cash? Is the growth sustainable? Is the risk being adequately compensated? By mastering this tool, you have separated yourself from the speculators who gamble on price action. You are now an investor who values businesses. Remember, the market is a voting machine in the short run, but a weighing machine in the long run. The DCF is your scale. Do not be intimidated by the complexity. Practice this model. Pick a stock you own, download its annual report, and run the numbers. You will be shocked at how often the market price deviates from reality. That deviation is your opportunity. Thank you for your dedication to your financial education. Now, go find the value that others are missing.